Well, joining us now for our Friday night chat about the economic issues of the week is economics correspondent Stephen Long. Stephen, welcome.
Hey, Ali.
Another day, another downgrade of a nation-state's credit rating. This time it's Spain. What does that mean?
I don't think it's going to mean a terrible lot, actually, Ali, because in this case it's not unexpected and I don't think it'll be catastrophic. It's really telling us what we already knew about Spain, but the underlying dynamics are a worry. Basically, another country downgraded, which means that banks holding its bonds have to raise more capital, that the cost of funding those countries goes up, and the whole spiral continues.
Well, of course, the G20 finance ministers are meeting again. Are they going to make any progress, or are they making any progress at all on these various rescue plans that we've talked about over recent weeks?
The details of the latest rescue plan, and I use that term advisedly, have pretty much leaked out, and it seems that what is going to be announced is that they're looking at a bigger haircut for the banks that hold Greek bonds. 21% initially they agreed to. They'll be looking at up to 60% losses on those bond holdings.
And that's essentially an organised default, isn't it, really?
It is. It's clearly a default. It's clearly already, it's a joke to say that Greece isn't in default. It is in default. This is going to be an organised default on Greece's debt. And then they're talking about increasing the capital that banks have to hold against government debt or sovereign debt to almost double what was agreed to when they did the stress testing of banks about their exposure. And that will mean that banks have to raise hundreds of billions more euros to cover this. And the question is, where does that money come from? Well, they're beefing up this European Financial Stability Facility, putting more money into it. But you can see that really the bank losses are going to take a fair bit of the money, even in this beefed up facility. So what they're going to do then to try and make it all work is that, because they've got to guarantee governments as well through this, is that they'll guarantee the first part of losses on any government debt, about 20%, the rest comes from the private sector. Now that's essentially a confidence trick because if any of the major countries get into trouble, Italy or Spain, then the whole thing doesn't work. Ultimately, the only way you can see this working is the European Central Bank eventually bankrolling it and monetising the debt, and I think that's where it will head.
And of course, even if they've come to an agreement, one of the problems with all these bailouts is that everything has to be agreed by everyone in the Eurozone, and we saw that this week, didn't we, with Slovakia, which managed to vote against one of the previous bailout packages.
Yes, well, we saw this weird situation, which I think really spooked a lot of people, where Slovakia, tiny country, and only recently, last couple of years, became a member of the Eurozone, voted down the bailout package, which meant potentially the whole upgrading of the European Financial Stability Facility could have fallen over. But it was tied to a confidence vote on the government. The government fell over. Now they voted for the package. But it just does show that vulnerability and the difficulties of getting unity in Europe to see all this achieved. Now, there is a big backdrop in Europe of the Second World War and the desire for unity, and we never want to see terrible events again. But push come to shove, there's also a lot of political interest and instability even within member states. How you get all this to work out, oh, it's a big ask.
Indeed, and I know there's certainly plenty of people already talking about how they can restructure those sorts of voting arrangements to mean that smaller countries that don't really have a stake or any money in it, or skin in the game, so to speak, can't hold the rest of the Eurozone to ransom. Stephen Long, many thanks for joining us.
You're welcome.